The dollar in your wallet used to mean something physical, not in a poetic sense, not as a slogan. In law, in 1792, the United States defined $1 as a specific weight of silver 371 and 1/4 grains of pure silver. That was not a metaphor, that was not branding, that was the legal definition. A dollar was silver. So the question is not whether silver is interesting, the question is much deeper. If the definition of the dollar changed, what is a dollar now? That question matters because most people live inside a money system they do not understand. They earn dollars, they save dollars, they retire in dollars, they price their home, their wages, their groceries, and their future in dollars. But they rarely ask what gives those dollars value, what used to back them, what was removed, and what happens when governments can create currency without the old metal constraint. This is not academic, it is your purchasing power, it is your retirement. It is the difference between a number in an account and what that number can actually buy. And right now silver sits at the center of a collision most people are not watching closely enough. On one side, every major government is printing, borrowing and expanding paper claims at a scale that would have shocked earlier generations. On the other side, the world is consuming more silver than it can mine. Year after year, the source describes 6 straight years of deficit and a cumulative shortfall approaching 1 billion ounces. That is not normal. A metal that once defined money is now being consumed by the technologies that define the future. Solar panels, electric vehicles, artificial intelligence data centers, semiconductors, 5G networks, medical devices, water purification, everyday electronics. Silver is no longer only a coin in a drawer. It is inside the operating system of modern civilization, and most of it, once used, is not economically recoverable. That is the first principle. If you do not understand silver, you do not fully understand the bridge between old money and the new industrial economy. For thousands of years, silver was the people's money. Gold was powerful, beautiful, and rare. It became the reserve metal of kings, temples, empires, and central banks. But gold was too scarce for everyday life. It was not practical for ordinary trade. You could not easily make change for bread or basic goods with a large piece of gold. Silver was different. Silver was rare enough to hold value, but common enough to circulate. It was divisible, it was measurable, it could be weighed, it could be tested, it could move through ordinary life. That is why silver became money for civilization. The Sumerians used silver as money thousands of years before the modern financial system existed. The Spanish silver dollar, the piece of 8, circulated globally for centuries. It became one of the first true reserve currencies because people trusted the metal. Not only the issuer, it was accepted across borders because the value was in the coin itself. Money used to be defined by weight, not by a politician's promise, not by a central bank's credibility, not by a line on a balance sheet, by metal. That may sound primitive to modern ears, but it imposed discipline. If money had to be made from metal, the government could not create unlimited units at will. It had to have the metal. It had to respect scarcity. That is the second principle. Sound money begins with a constraint. When the constraint is removed, the temptation to create more money becomes much stronger. Alexander Hamilton understood that a growing economy needed enough money to function. Gold alone was too scarce, so the early American system recognized both gold and silver. This bimetallic structure gave the economy a broader monetary base. Silver supported everyday transactions. Gold supported larger stores of value. Both were tied to physical scarcity in that world. If you held a coin, you held the thing itself. You could melt it, you could weigh it, you could verify it. The government's promise mattered less because the metal had value independent of the government. That was the original logic, then came the break. In 1873, Congress passed the Coinage Act that removed the silver dollar from legal tender status. Silver was effectively pushed out of the monetary system. America moved toward a gold, only standard. The language sounded technical, but the impact was not technical for the people who lived through it. The money supply tightened, deflation followed, prices fell. Farmers were crushed because they borrowed money to plant crops, then sold those crops at lower prices and could not repay debts. Wages fell, unemployment rose, ordinary people felt the pressure. The event became known as the crime of 1873 because many believed it transferred power away from the people who used silver and toward financial elites who benefited from tighter money. Whether one argues every detail of that period or not, the deeper point is clear. Changing the monetary base changes who has power. That is the third principle. Money is not neutral when its definition changes. The people closest to the new system usually adapt first. The people farthest from power usually feel the pain first. Then came the final break in 1971. President Nixon severed the last link between the dollar and gold. After that, the dollar was no longer directly backed by silver or gold. It was backed by trust. Trust in the government, trust in the central bank, trust in the economy, trust in the military, trust in the tax system, trust in global demand for dollars, trust that other people would keep accepting it. That is a very different kind of money. A metal-backed dollar is constrained by what can be found, mined, and refined. A fiat dollar is constrained by policy, politics, credibility, and confidence. Those constraints are weaker because human beings under pressure tend to choose short-term relief over long-term discipline. When debt rises, print. When deficits rise, borrow. When crisis arrives, expand the balance sheet. When voters demand benefits without immediate pain, promise more. This is how fiat systems behave, not because every person involved is evil, because incentives push in that direction. That is the fourth principle. A money system based on trust must constantly earn that trust. If it abuses the trust, the currency may survive in name while losing value in purchasing power. Most people do not experience currency debasement as a dramatic announcement. They experience it as life getting more expensive. Groceries cost more, insurance costs more, housing costs more, education costs more, healthcare costs more, retirement requires more. The number of dollars rises, but the value of each dollar falls. This is why the original question matters. If the dollar used to be a defined weight of silver, and now it is no longer defined by metal, what anchors it? The answer is confidence, and confidence is powerful until it weakens. Now, silver is no longer officially money in the same way it once was, but it has not become irrelevant. It has changed roles. It now has a dual identity. It is still a precious metal, a store of wealth, a hedge against currency debasement, and a form of monetary insurance. But it is also an industrial metal, and that second identity is what makes silver very different from gold. Gold is mostly hoarded. Central banks buy it, investors hold it, jewelry stores it. Almost every ounce of gold ever mined still exists in some recoverable form. Silver is different. Silver is consumed. It goes into phones, laptops, cars, solar panels, medical devices, circuit boards, sensors, chips, and billions of small components. It is used in tiny quantities spread across countless products. Once it is inside those products, recovering it is often uneconomic. The cost of extracting a few milligrams from a discarded device can exceed the value of the silver recovered. That means industrial use can permanently remove silver from accessible supply. This is the fifth principle. Gold is mostly stored, silver is partly consumed. That one difference changes the investment case. If silver were only monetary, the story would be about currency debasement and precious metal demand. But silver is also industrial, so the story includes technology, energy transition, electrification, data centers, and supply chains. The source says roughly 60% of silver demand is industrial, while gold's industrial demand is closer to 10%. This makes silver a different asset. It is not simply poor man's gold, it is gold's monetary cousin with industrial leverage attached. Silver is the most electrically conductive metal on Earth. Better than copper, better than gold. It is also the most thermally conductive metal that matters for heat management in electronics. It is the most reflective metal that matters for solar panels. In many applications, there is no simple substitute at the same performance level and comparable cost. Copper, aluminum, graphene, and other materials may help in some areas over time. But silver's combination of conductivity, reflectivity, and thermal performance remains extremely difficult to replace at scale. That is the sixth principle. Silver's value is not only that people believe in it. Its value also comes from properties that modern technology needs. This is why the supply-demand situation matters so much. Solar is one of the largest industrial users of silver. Every solar panel requires silver for electrical connectivity. The industry has tried to reduce silver content per Pascal Nel because silver is expensive. The source describes a reduction of about 30% over the last decade at first. That sounds bearish. If each panel uses less silver, maybe silver demand falls, but that misses the scale effect. Solar installations are expanding so rapidly that the reduction in silver per Pascal Nel can be overwhelmed by the increase in the number of panels installed. Governments are mandating massive solar buildouts. The source expects solar capacity to triple by 2030. And the most advanced high-efficiency solar technologies may use more silver, not less. So the total demand can keep rising even if each unit becomes more efficient. That is the seventh principle. Efficiency can reduce metal use per unit, but growth in total units can still increase total demand. This is a common mistake in resource analysis. People look at substitution or thrifting and assume demand must fall, but if the end market grows faster than material reduction, total demand rises. Solar is not the only driver. Electric vehicles use roughly twice as much silver as traditional vehicles, according to the source. They need more electrical contacts, more sensors, more battery connections, more power electronics, and more complex systems. Every connection matters. Every switch and circuit can require small amounts of silver. If electric vehicles become a much larger share of global auto sales, silver demand from vehicles rises. Then there is artificial intelligence. AI data centers require enormous computing power. Computing power creates heat. Heat must be managed. Silver is used in thermal management systems and electronics. As data center construction accelerates, this adds another source of silver demand. Then there are semiconductors and 5G faster chips, higher power density, faster transmission, smaller circuits, antennas, and efficiency requirements all push the system toward materials with high conductivity and reliability. Silver fits that need. This is the eighth principle. The technologies defining the future are not weightless. They are built from physical materials. People talk about AI as if it exists in the cloud, but the cloud sits in data centers. Data centers require chips. Chips require materials. Power systems require metals. Heat management requires metals. Networks require metals. The digital world is built on the physical world, and silver is one of the physical inputs. Now, let us move from demand to supply. The source says that for 6 years in a row, the world has consumed more silver than miners have produced. Deficits in 2021, 2022, 2023, 2024, 2025, and a projected deficit in 2026 of 67 million ounces. From 2021 to the present, the cumulative shortfall is described as approaching 1 billion ounces. That metal did not come from nowhere. It came from inventories, warehouses, ETF holdings, exchange stockpiles, visible reserves. The system has been drawing down stored silver to meet current demand. That can continue for a while, but not forever. This is the ninth principle. A deficit can be hidden by inventories until inventories are drawn down enough that the market is forced to reprice scarcity. This is similar to oil inventories, but with a different structure. If annual consumption exceeds mine supply, the deficit must be filled from above ground stocks. As those stocks decline, the market loses its buffer. The tighter the physical market becomes, the more sensitive price can become to demand surprises. Now, why do miners not simply produce more silver? Because most silver is not produced from primary silver mines. It is often a byproduct of mining other metals such as lead, zinc, copper, and sometimes gold. That means silver supply is tied to the economics of other metals. If copper or zinc production falls, silver output may fall too. If silver prices rise, miners cannot always respond quickly because their mine plans are driven by the main metal, not silver. This makes silver supply inelastic. That word simply means supply does not respond quickly to price. If silver rises to $100 or $200, supply does not instantly flood the market. New mines take time. Exploration, permitting, financing, environmental review, litigation, construction, and commissioning can take 10 to 15 years. That is a long delay. Demand can rise. Now supply responds slowly. That creates structural pressure. This is the 10th principle. When demand rises quickly and supply responds slowly, price can move violently. This is why silver can be so volatile. The market is relatively small. The supply response is slow. Industrial demand is large. Monetary demand can arrive suddenly. If investors wake up at the same time industrial users are already consuming more than miners produce, the price can move fast. That is the opportunity. It is also the risk. Silver can move 30 to 50%. That kind of volatility is normal for silver. It can go up quickly and then fall hard. Anyone who buys silver without understanding that can get hurt. This is not an asset for people who need short-term certainty. That is the 11th principle. Volatility is not the same as risk, but volatility becomes risk if you are forced to sell or if your position is too large. A person who understands why they own silver, sizes it properly, and holds it for the right reasons may survive volatility. A person who buys emotionally after a rally and panics during a decline may be destroyed by the same asset. The asset is not enough, the behavior matters. Now, one of the most useful tools for understanding silver is the gold to silver ratio. The ratio is simple. Take the price of 1 ounce of gold, divide it by the price of 1 ounce of silver. The number tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has moved in cycles. In the 20th century, the average was around 47. According to the source, in more recent decades, it has often fluctuated between 50 and 70, with extreme spikes near 100 or even higher in moments of stress like 2020. When the ratio is high, silver is usually cheap relative to gold. When the ratio is low, silver is usually expensive relative to gold. This does not give perfect timing. No single metric does. But it gives context. If the ratio is 80, 90, or 100, silver may be deeply undervalued relative to gold. If the ratio falls below 60, silver may already be outperforming and may be closer to a profit-taking or rebalancing zone, depending on the rest of the market. That is the 12th principle. The gold to silver ratio is not a prophecy. It is a relative value signal. It helps you understand when silver is cheap or expensive compared with gold. This matters because many people buy silver based on excitement. They hear a story, they see a chart, they feel that everyone is talking about it. They buy near a local top. Then silver falls and they become angry. Even though the asset is behaving exactly as a volatile asset behaves, a ratio-based approach can help reduce emotion. It gives a framework when silver is very cheap relative to gold. Accumulate carefully if it fits the portfolio. When silver has strongly outperformed and the ratio compresses, consider rebalancing or taking some profits if that matches the plan. The point is not to trade every wiggle. The point is to avoid buying only when excitement is already extreme. This is the 13th principle. You do not make money only by buying the right asset. You also need a discipline for when to buy, when to hold, and when to sell. Many people study why to buy and never study when to sell. That is dangerous. Silver can have spectacular rallies. It can also punish late buyers. Profits are not real until they are managed. A position that doubles and then collapses can teach a painful lesson. Not because the thesis was wrong forever, but because the investor had no exit or rebalancing rule. This is especially true for ETFs, miners, and leveraged or market-based silver exposure. Physical silver is different because many people hold it as long-term insurance rather than a trading vehicle. If the purpose is insurance, the selling rule may be different. But if the purpose is market profit, exit rules matter. That is the 14th principle. The purpose of the silver position determines the selling strategy. If silver is insurance, you may hold through volatility. If silver is a trade, you need profit rules. If silver is part of a diversified allocation, you may rebalance. If silver is a speculative overweight, you need strict risk control. Do not confuse these purposes. Now, let us address the myths. The first myth is that silver is just poor man's gold. That view is too simple. Gold is primarily a monetary metal. Central banks hold it. Investors hold it. It has very little industrial demand compared with silver. Silver has monetary characteristics and industrial demand. That makes it a hybrid asset. Gold is insurance. Silver is insurance, plus industrial leverage. That does not make silver better in every situation. It makes silver different. Gold may be more stable as a pure monetary reserve. Silver may have greater upside in certain industrial and monetary regimes, but also greater volatility. If the economy weakens badly, industrial demand may hurt silver. If monetary fear rises and industrial demand remains strong, silver may outperform. That is the 15th principle. Silver is not a smaller version of gold. It is a different asset with different drivers. The second myth is that silver is too volatile to be useful. Volatility is real, but volatility is not automatically the same as long-term risk. If you buy the wrong side, volatility becomes destructive. If you buy for the wrong reason, volatility becomes emotional torture. But if you size it properly and understand the role, volatility can be tolerated. Silver's purpose in a portfolio may be wealth preservation, diversification, inflation protection, and exposure to industrial scarcity. It is not meant to be a perfectly smooth bank deposit. In the 1970s, when inflation raged, silver rose dramatically. In the 2000s, silver also moved from very low levels to much higher levels. Those moves were not smooth, but they were meaningful for investors who understood the cycle and could handle volatility. That is the 16th principle. An asset can be volatile and still be useful if its role is clear and its size is controlled. The third myth is that silver is hard to buy or store. Today, silver can be bought in several ways: physical coins and bars from reputable dealers, insured vault storage, digital platforms that represent ownership of physical metal, ETFs, mining stocks. Each method has different risks. Physical silver gives direct ownership, but storage and security matter. Vaulted silver can reduce home storage risk, but you must trust the custodian and verify audits. ETFs are convenient and liquid, but they carry fund structure and counterparty considerations. Mining stocks can give leverage to silver prices, but they are businesses with operational, jurisdictional, management, cost, and market risks. There is no perfect form. That is the 17th principle. The silver thesis is one thing. The vehicle you use to express it is another. A person can be right about silver and wrong about a miner. A person can be right about long-term silver and still suffer if they buy a leveraged instrument. A person can own physical silver but face storage risk. A person can own an ETF but accept financial system exposure. Every vehicle has trade-offs. The fourth myth is that silver is obsolete. That is almost the opposite of reality. Silver is embedded in the future. Solar electric vehicles, AI chips, 5G, medical technology, water purification, and electronics all use silver. Its industrial relevance is increasing, not disappearing. This is why the setup is rare. You have monetary uncertainty and industrial demand at the same time. Governments expand fiat money. People look for hard assets. Industry consumes silver. Mine supply is constrained. Inventories are drawn down. That combination does not appear often. That is the 18th principle. The strongest commodity setups often occur when monetary demand and industrial demand point in the same direction. Silver may have both. Now let us talk about interest rates and the dollar. Silver is sensitive to central banks. If the Federal Reserve keeps interest rates higher, silver can be pressured. Higher real rates can make non-yielding metals less attractive. A strong dollar can also hurt silver because silver is priced in dollars. For foreign buyers, a stronger dollar makes silver more expensive in local currency, reducing demand. This is a real risk. Do not ignore it. A strong silver thesis can still be interrupted by high rates and a strong dollar. The long-term supply-demand story may remain intact, but price can fall in the short to medium term. That is the 19th principle. A good long-term thesis can suffer from bad short-term macro conditions. If you do not understand that, you may sell at the wrong time or buy too large too early. This is why position sizing matters again. If silver falls 40% because of macro pressure, can you hold? If the answer is no, the position is too large or the strategy is wrong. Now let us talk about substitution risk. If silver rises dramatically, industries will have stronger incentives to use less of it or replace it. Engineers are always trying to reduce costs. Copper nanowires, graphene, alternative materials, and new manufacturing techniques may reduce silver demand over time if they become commercially viable at scale. So far, silver's performance remains difficult to match in many applications. But if the price rises enough, the incentive to solve the substitution problem increases. This is another risk. The 20th principle: high prices create the incentive to destroy the demand case. This is true in oil, copper, silver, and many commodities. When a commodity becomes too expensive, users try to use less, substitute, recycle, or redesign systems. The timing and success of substitution are uncertain, but the incentive is real. Investors must monitor it. Now, let us think about recycling. Gold is recycled because it is valuable and concentrated. Silver is often used in tiny quantities across billions of products. The cost of recovery can exceed the value. That makes recycling harder. This is why much industrial silver is effectively consumed. If silver prices rise enough, recycling economics may improve. But that takes infrastructure, collection systems, processing, and time. It does not immediately solve a structural deficit. That is the 21st principle. Recycling can help at high prices, but it is not an instant solution when the metal is widely dispersed. This matters because the industrial use of silver is not like storing bars in a vault. It is scattered across devices, panels, circuits, and components. Once dispersed, recovery is difficult. Now, let us examine the supply deficit more closely. If the world consumes more silver than mines produce for multiple years, inventories must decline. A one-year deficit can be manageable. A multi-year deficit becomes structural. If industrial demand continues rising and mine supply is slow to respond, the deficit can persist. The source says 2026 is projected to have a 67 million ounce deficit. Even if that number changes, the important idea is that the market is not comfortably oversupplied. That is the 22nd principle. One deficit is a cycle. Repeated deficits may be a structural change. The market often ignores structural changes until the physical stress becomes visible. Exchange inventories fall, premiums rise, delivery concerns appear, the gold to silver ratio moves, investor interest returns, prices jump. By then, early accumulation may already have been rewarded. That is why serious investors watch the physical market before the mainstream headline arrives. Now, let us connect silver to money again. The dollar loses purchasing power over time by design. The system targets positive inflation, governments borrow. Central banks expand and contract liquidity. Currency units grow, the nominal economy rises, but the individual holding cash must ask whether their purchasing power is being preserved. Silver has served as money or a store of value for thousands of years. It is not perfect. It is volatile. It produces no income. It requires storage. It can underperform for long periods, but it is not someone else's liability. That is important. A dollar is someone else's promise. A bond is someone else's promise. A bank deposit is a claim on an institution. A share of stock is ownership in a business. Silver is a physical asset. It does not promise it exists. That is the 23rd principle. Hard assets matter most. When confidence in paper promises weakens, this does not mean you put everything in silver. That would be reckless. It means silver can play a role in a system designed to survive currency debasement, inflation, and industrial scarcity. A portfolio can include cash, stocks, bonds, real estate, gold, silver, and other assets. Each has a job. Silver's job may be monetary insurance plus industrial upside, but it must be sized rationally. Now let us talk about why people get hurt in silver. They buy after a strong rally. They have no plan. They use money they need soon. They hold mining stocks thinking they are the same as metal. They do not understand volatility. They panic when silver drops. They refuse to take profits when the ratio signals silver has become expensive. They believe only the upside story and ignore rates, the dollar substitution, and liquidity. They treat silver like a guaranteed short-term trade. That is how people lose money in a good asset. The 24th principle. Good assets can still create bad outcomes when purchased for the wrong reason at the wrong size and wrong time. This is why education matters. If silver falls after you buy, the first question is not whether the asset betrayed you. The first question is whether your thesis, size, and time horizon were correct. If you bought silver as long-term insurance and sized it properly, a decline may be tolerable. If you bought it as a short-term trade without an exit, a decline may be painful. Know the difference now. Let us think about the gold. To what silver ratio? Again, if the ratio is high, silver may be cheap relative to gold. That can be an accumulation signal. If the ratio falls sharply, silver is outperforming gold. That may be a signal to rebalance, take profits, or at least stop chasing. In 2020, the ratio spiked extremely high and then collapsed as silver doubled while gold did less. That kind of move shows how quickly silver can reprice when the market shifts. This is why the ratio is useful. It does not tell you everything, but it helps prevent emotional blindness. The 25th principle, relative value tools help investors avoid buying only when the crowd is already excited. Now let us talk about miners. Silver miners can be attractive because they may offer leverage to silver prices. If silver rises, a miner's profits can rise faster than the metal price if costs are stable. But miners carry risks the metal does not carry. Operational problems, cost overruns, energy costs, labor disputes, political risk, permitting delays, environmental rules, management mistakes, debt dilution, jurisdictional risk, commodity exposure beyond silver because many mines produce multiple metals. So mining stocks are not the same as silver. They are businesses tied to silver. That is the 26th principle. Mining stocks are leveraged businesses, not pure metal. Do not buy miners thinking they are the same as holding physical silver. They may outperform in bull markets and underperform badly in downturns. Again, vehicle matters. Now let us think about ETFs. ETFs can provide easy exposure. They are liquid. They can be bought and sold quickly. They fit inside brokerage accounts, but they are financial instruments. They rely on custodians, fund structures, market liquidity, and legal claims. For many investors, that convenience is valuable. For others who want physical insurance outside the financial system, ETFs may not serve the same role. This is why purpose matters. Physical silver may be insurance. Silver ETFs may be market exposure. Miners may be leveraged equity exposure. Each has a job, the 27th principle. You should choose the vehicle based on the job you need silver to do. Do you want long-term physical insurance? Do you want liquid price exposure? Do you want leveraged upside through mining companies? Do you want to trade? Do you want portfolio diversification? Different goals require different vehicles. Now let us talk about storage. If you hold physical silver at home, you have access, but you also have theft risk, fire risk, and the need for secure storage. Silver is bulky compared with gold. A meaningful dollar amount of silver takes space. If you use vault storage, you reduce home risk, but add counterparty and access risk. If you use pooled storage, allocated storage, or unallocated storage, the legal details matter. That is the 28th principle. Physical ownership is not complete unless custody is understood. People say they own metal, but ownership form matters. Allocated metal is different from pooled claims. Audited vaults are different from vague promises. Home storage is different from institutional storage. Again, structure matters. Now, let us think about inflation hedging. Silver has historically performed well in certain inflationary periods, but not every inflationary environment produces the same result. If inflation rises and central banks respond with high real rates, metals may struggle. If inflation rises and real rates remain low or trust weakens, metals may do very well. So silver is not a mechanical inflation switch. It is a hedge with conditions. The 29th principle, inflation matters, but real rates and currency confidence determine how metals respond. This is why central banks matter. Silver dislikes strong real yields because it produces no income. If investors can earn high real returns in safe assets, metals become less attractive. But if real yields are low, negative, or not trusted, hard assets become more attractive. Now let us discuss monetary demand. Central banks buy gold more than silver. Gold is the official reserve metal. Silver is not usually held by central banks in the same way. But investors can buy silver as a private monetary hedge. This distinction matters. Gold has official monetary demand. Silver has private monetary demand plus industrial demand. If public distrust in currencies rises, both gold and silver can benefit. Silver may move more dramatically because the market is smaller and more volatile. The 30th principle, silver can act like a monetary metal during currency fear and like an industrial metal during technology expansion. That dual identity is powerful but unstable. It can make silver outperform in some regimes and underperform in others. This is why it must be understood as a hybrid. Now, let us bring the story back to money. In 1792, a dollar was defined as silver. In 1873, silver was removed from the monetary system. In 1971, the dollar's final link to metal was severed. Today, the dollar rests on confidence while silver is demanded by both investors and industry. The historical arc is important because it shows what changed. Money moved from measurable scarcity to institutional promise. Silver moved from everyday money to strategic industrial and monetary asset. That is the 31st principle. When money loses its metal definition, metals do not lose relevance. They change function. They become mirrors showing what is happening to paper confidence and physical scarcity. This is why silver matters now. Not because the world is going back exactly to 1792, it is not. The future will not simply copy the past, but the past teaches us that money systems can change, that definitions can be altered, and that ordinary people can be harmed when they do not understand the change until too late. Now let us think about the emotional part of silver investing. Silver attracts passionate believers. Some believe it is suppressed. Some believe a squeeze is inevitable. Some believe it must return to a historical ratio with gold. Some believe it will explode because of industrial demand. Some believe it is the ultimate rebellion against fiat money. Some of those arguments may contain truth, but emotional certainty is dangerous. A serious investor must separate belief from process. What is the allocation? What is the time horizon? What is the vehicle? What is the buying signal? What is the selling or rebalancing rule? What invalidates the thesis? What risks are being monitored? Without those answers, silver can become an ideology rather than an investment. That is the 32nd principle. An asset becomes dangerous when it becomes part of your identity. If you cannot evaluate it calmly, you may hold too much. If you cannot sell or rebalance, you may be controlled by the story. The story may be powerful, but the system must govern the position. Now, let us think about how to size silver. There is no universal allocation. Some people may hold a small percentage as insurance. Some may hold more if they have strong conviction and can tolerate volatility. Some may use it tactically when the gold to silver ratio is high. Some may avoid it because volatility does not fit their plan. The key is that the position should not force emotional decisions. If a 30% drop would ruin your plan or your sleep, the position is too large if you need the money in the next year. Silver is probably not the right place for that money. If you buy miners with money needed for stability, you are taking equity and commodity risk at the same time. That is the 33rd principle. Position size should be determined by the loss you can survive, not only the gain you imagine. This is true for every volatile asset. Silver's upside can make people forget downside. Do not forget now. Let us talk about why the mainstream financial media often ignores silver. Silver is a small market compared with stocks, bonds, real estate, and currencies. It does not produce steady fees for the financial system in the same way many managed products do. It is physically complex. It has both monetary and industrial drivers. It is volatile. It can make professionals uncomfortable because it raises questions about fiat money. But ignoring it does not make it irrelevant. The physical deficit still matters. Industrial demand still matters. The monetary history still matters. The gold to silver ratio still matters. Inventories still matter. That is the 34th principle. A market does not need mainstream attention to become structurally important. Sometimes the lack of attention is part of the opportunity, but lack of attention can also mean illiquidity and volatility. Again, opportunity and risk come together. Now, let us think about industrial demand in a downturn. If there is a global recession, industrial demand for silver could weaken. Solar projects could be delayed, EV sales could slow, electronics demand could fall, Data center investment could pause or slow. That would pressure silver, at least temporarily. This is another risk. However, policy-driven solar build-out, electrification, and AI infrastructure may have secular momentum that survives ordinary cycles. Though the pace can change, that is the 35th principle. Structural demand can still have cyclical setbacks. Do not confuse long-term direction with a straight-line path. Silver demand may be strong over a decade and still fall in a recession year. Investors must be prepared. Now let us discuss the concept of a squeeze. A silver squeeze occurs when physical demand and investment demand strain available supply, forcing rapid repricing, exchange inventories, delivery demands, ETF flows, futures positioning, and physical premiums can all matter. The source mentions tracking when silver may be ripe for a squeeze. This is a specialized area. The important point is that silver's market is small enough that shifts in physical demand and investor behavior can create dramatic moves. But squeeze narratives also attract speculation and hype. That is the 36th principle. Squeeze potential is real only when supported by physical tightness, not just online excitement. Watch inventories, watch premiums, watch delivery stress, watch the gold to silver ratio, watch industrial demand, watch the dollar, watch rates. Do not rely only on slogans now. Let us bring everything into a cause and effect chain. The dollar once had a silver definition. The definition was removed. The monetary system became more dependent on trust. Governments expanded paper money dramatically. Silver retained monetary appeal because it is scarce and physical. At the same time, industrial demand rose because silver is essential for solar EVs, AI, chips, 5G, and electronics. Silver is consumed in many of these uses and often not economically recovered. Mine supply is constrained because silver is mostly a byproduct and new mines take many years. Deficits have persisted for multiple years. Inventories have been drawn down. The gold to silver ratio provides a relative value signal. Silver offers both opportunity and risk because it is volatile, rate sensitive, dollar sensitive, and vulnerable to substitution over time. That is the system. The 37th principle, the silver thesis is strongest when monetary stress and physical scarcity reinforce each other. If only one side exists, the case may still be valid. If both sides exist together, the setup becomes rare. Now, let us think about what an ordinary person should do with this knowledge. First, do not ignore silver. Second, do not worship silver. Third, understand its role. Fourth, decide whether physical metal, ETF exposure, mining stocks, or no exposure fits your plan. Fifth, size the position so you can survive volatility. Sixth, use signals like the gold to silver ratio and inventory trends to avoid purely emotional buying. Seventh, understand that higher rates and a strong dollar can hurt silver. Eighth, watch substitution and recycling over the long term. Ninth, avoid thinking silver is guaranteed to go up just because the story is compelling. 10th, remember that silver is not a replacement for a full financial plan. That is the 38th principle. Understanding an asset does not require going all in. A good portfolio is a system of different assets with different jobs. Silver's job may be to protect against currency debasement, inflation, and industrial scarcity. But cash has a job, stocks have a job, bonds have a job, real estate has a job, gold has a job. Balance matters. Now let us talk about why this matters to retirement. Retirement is a long-term purchasing power problem. You do not retire on account numbers. You retire on what those numbers can buy. If the dollar loses purchasing power over time, then holding only paper cash can create risk. If the financial system changes, hard assets may provide diversification. Silver is not the only answer, but it is one answer to consider because it combines scarcity with real-world demand. That is the 39th principle. Retirement planning is not only about return, it is about preserving purchasing power across changing monetary regimes. A stock portfolio may grow. Bonds may provide income. Cash provides liquidity. Gold and silver may provide hard asset insurance. The mix depends on the person. Now, let us think about the phrase, silver preserved wealth for 5,000 years. That statement should be understood carefully. Silver has been used as money and store of value for millennia, but its purchasing power has fluctuated dramatically across periods. It is not a smooth asset, it is not a guaranteed linear protector, but it has survived as a recognized store of value in ways many paper currencies have not. That is the point. Paper systems come and go. Silver remains physical. The 40th principle, the long life of a hard asset does not remove volatility, but it does reveal durability. Silver has endured because it has both monetary history and physical usefulness. That combination is rare. Now let us discuss the final big picture. Silver is not a get-rich-quick play. If someone buys it expecting immediate riches, they may be disappointed. Silver is also not dead. If someone dismisses it as a relic, they may miss one of the most important physical inputs in the technology shaping the future. Silver is not simply poor man's gold. It has a different demand structure. Silver is not safe in the short term. It is volatile. Silver is not impossible to own. But custody and vehicle choice matters. Silver is not guaranteed. Rates, the dollar substitution, recession, and investor behavior can all hurt it. The correct view is balanced. Silver is monetary insurance plus industrial leverage with high volatility. That is the 41st principle. The truth about silver is more powerful than the hype because the truth includes both the opportunity and the risk. Hype says silver can only go up. Fear says silver is too volatile to own. A systems view says silver has a rare setup but must be owned intelligently. That is how I would approach it. Now let us return to the opening question. If the dollar was once silver, what is it now? It is a claim built on trust, that trust may remain strong for a long time. The dollar remains the dominant currency. The United States remains powerful. The global financial system still runs heavily on dollars. But trust-based systems must be monitored. Debt matters, deficits matter, money printing matters, inflation matters, central banks matter, commodity scarcity matters, industrial demand matters, and when an old monetary metal becomes essential to new technology at the same time governments are expanding paper money, the signal deserves attention. That is the final principle. Silver is not only a metal, it is a test of whether you understand money as both history and supply, demand reality. Most people will not understand this until after the price has moved. They will wait for the mainstream to explain it. They will wait for the headline. They will wait until silver is exciting again. Then they may buy late, panic during volatility and blame the asset. A better investor studies the system before the crowd cares. That does not mean rushing. It means understanding. Understand the monetary history. Understand the industrial demand. Understand the structural deficit. Understand the mining constraint. Understand the gold to silver ratio. Understand the risks. Understand the vehicle. Understand the role in the portfolio. Then decide. That is how I would think about silver. Not as a religion, not as a trade to chase, not as a fantasy, as a scarce physical asset with a 5,000-year monetary history, a growing industrial role, a difficult supply response, and a volatile price structure that can reward patience and punish emotion. If you understand that, you understand much more than silver. You understand how money changes. You understand how scarcity matters. You understand how technology consumes the physical world. You understand why paper promises and hard assets behave differently. And you understand why the dollar in your wallet is not the same thing it was when the law defined it as silver. That is why silver matters, because the story of silver is also the story of money itself.